Every nation in the world, from the wealthiest superpower to the smallest developing state, carries some form of national debt. News headlines often warn about rising deficits, trillion-dollar borrowing, and global financial crisis. This leads to a puzzling and thought-provoking question: if almost every country is in debt, who exactly do they owe? It may seem confusing to imagine a world where everyone owes money, because in everyday life, if someone is in debt, someone else must be the lender. So how does that work on a global scale? The answer reveals a complex and interconnected financial system where governments borrow not from a single authority, but from investors, institutions, other nations, and sometimes even their own citizens. National debt is not simply a sign of economic failure, it is part of how modern economies function, grow, and respond to challenges. Understanding who countries owe and why helps us better understand how the global economy truly operates. Most countries primarily borrow money from investors rather than from some single global authority. When a government needs funds, whether to build infrastructure, support social programs, finance defense, or stimulate the economy, it issues bonds. These bonds are essentially promises to repay borrowed money with interest over a specified period. Investors purchase these bonds because they are generally considered safe and reliable, especially when issued by stable governments. In this way, national debt is not a mysterious obligation owed to an abstract entity called the world, but a structured financial relationship between governments and investors. These investors come from many different sectors of society. Commercial banks buy government bonds as part of their secure asset holdings. Pension funds invest in them to ensure stable, long-term returns that can support retirees. Insurance companies purchase them to balance risk in their portfolios. Mutual funds and individual investors also participate, often through bond markets that allow ordinary citizens to indirectly lend money to their own governments. In many cases, a significant share of a country's debt is held domestically, meaning the government is effectively borrowing from its own population and institutions. Central banks also play an important role in this process. For example, the Federal Reserve buys U.S. government bonds to manage monetary policy and stabilize the economy. When central banks purchase bonds, they inject liquidity into the financial system, influencing interest rates and economic activity. This demonstrates that part of national debt can be owed to a country's own central financial authority, further reinforcing that governments often owe money within their own economic system. Foreign investors also purchase government bonds, adding an international dimension to national debt. Large institutional investors and sovereign wealth funds seek stable returns by investing in the bonds of economically strong nations. This global participation reflects trust in certain economies and connects financial systems worldwide. Instead of being a burden imposed by an external force, debt becomes part of a complex global network of investment and confidence. Ultimately, government borrowing operates much like borrowing at a smaller scale, except the lenders are diverse and often include the country's own financial institutions and citizens. The existence of debt does not mean a country is owned by someone else. It means that it participates in a structured financial system where investors provide capital in exchange for predictable returns, helping governments fund their operations and long-term development. A significant portion of many countries' national debt is actually owed to their own citizens and domestic institutions. This may seem surprising at first because debt is often imagined as money borrowed from foreign nations. In reality, governments frequently borrow internally by issuing bonds that are purchased by local investors. These investors include commercial banks, pension funds, insurance companies, mutual funds, and even ordinary citizens who invest in government securities either directly or through financial markets. This means that in many cases, the government is borrowing money from the very people and institutions that operate within its own economy. When citizens buy government bonds, they are essentially lending money to their own country in exchange for interest payments over time. Pension funds, for example, rely heavily on government bonds because they are considered low risk and provide stable returns. These returns are then used to pay retirees. Insurance companies also invest in government securities to ensure they can meet future claims. Banks hold government bonds as part of their required reserves and as safe assets that help balance their portfolios. Through these mechanisms, Debt becomes a tool that circulates money within the national economy rather than simply transferring it abroad. Central banks further reinforce this internal ownership of debt. Institutions like the Federal Reserve purchase government bonds as part of monetary policy operations. When a central bank buys bonds, it injects money into the economy, supports liquidity, and helps manage interest rates. In such cases, the government is effectively paying interest to an institution that is part of its own financial system. This creates a cycle where debt obligations remain largely within national borders, reducing dependence on external creditors. In countries with strong domestic financial systems, internal borrowing can account for a large percentage of total public debt. This structure provides stability because governments are less vulnerable to sudden changes in foreign investor sentiment. If most creditors are domestic institutions, the government has greater flexibility in managing repayment terms and financial policies. It also means that interest payments often flow back into the domestic economy, supporting businesses, retirees, and financial markets rather than leaving the country entirely. Understanding this internal dynamic changes the perception of national debt. Instead of viewing it solely as money owed to outsiders, it can be seen as a financial relationship within a country's own economic system, where the government and its citizens are interconnected through investment, savings, and long-term financial planning. In addition to domestic investors, foreign governments also play a major role in holding national debt. Countries often purchase each other's government bonds as part of their foreign exchange reserves. These reserves are assets held by a nation's central bank to stabilize its currency, manage trade imbalances, and maintain confidence in its financial system. Instead of keeping large amounts of foreign currency in cash, governments invest in stable and reliable assets, most commonly government bonds issued by economically strong nations. For example, countries such as China and Japan have historically held significant amounts of U.S. Treasury securities. They purchase these bonds because the United States has one of the largest and most stable economies in the world, and U.S. government bonds are considered relatively low-risk investments. By holding these securities, foreign governments earn interest while also maintaining a safe place to store large reserves of U.S. dollars accumulated through international trade. This relationship is often closely connected to trade dynamics. When a country exports more goods than it imports, it may accumulate large amounts of foreign currency. Rather than letting that currency sit unused, the government invested in bonds issued by the importing country. In this way, global trade and global debt are interconnected. One country's trade surplus can turn into investment in another country's debt, creating a financial link between their economies. Foreign ownership of debt does not necessarily mean one country controls another. Government bonds are financial instruments with clear legal terms, including fixed interest payments and maturity dates. Creditors cannot simply demand control over national policies in exchange for holding bonds. However, large levels of foreign-held debt can increase financial interdependence. If foreign investors lose confidence and sell large amounts of bonds, it can influence interest rates and currency values. This is why maintaining economic stability and investor trust is so important for governments. The participation of foreign governments in debt markets reflects the deeply interconnected nature of the global financial system. Countries lend to one another not as an act of charity or dominance, but as a strategic financial decision that supports currency management, trade balance, and investment returns. Through this system, national debts become part of a broader network of global economic relationships, where borrowing and lending tie countries together in complex and often mutually beneficial ways. Beyond private investors and foreign governments, international financial institutions also lend money to countries, especially during periods of economic difficulty. Organizations such as the International Monetary Fund and the World Bank were created to promote global economic stability and development. They provide financial assistance to countries facing budget deficits, currency crises, or long-term development challenges. When nations struggle to borrow from private markets due to high risk or low credit ratings, these institutions often step in as lenders. The International Monetary Fund primarily focuses on short to medium-term financial stabilization. When a country experiences a balance of payments crisis, meaning it cannot pay for imports or meet external debt obligations, The IMF may provide emergency loans. These loans are typically tied to policy reforms designed to restore economic stability. Such reforms can include reducing government spending, adjusting tax systems, improving transparency, or restructuring state-owned enterprises. The goal is to help the country regain financial credibility so it can eventually return to borrowing from private markets. The World Bank, on the other hand, focuses more on long-term development projects. It provides funding for infrastructure, education, healthcare, poverty reduction, and environmental sustainability. Developing nations often rely on World Bank loans to build roads, power plants, schools, and water systems. These projects are intended to strengthen economic growth over time, enabling countries to generate more revenue and improve living standards. In this case, debt is used as a tool for investment in national development rather than short-term crisis management. Loans from these institutions differ from regular bond borrowing because they often come with structured programs and oversight. Countries receiving assistance may undergo economic monitoring and periodic evaluations to ensure that funds are used effectively and that reforms are implemented. While some critics argue that such conditions can be strict or politically sensitive, supporters claim they encourage responsible fiscal management and long-term stability. International lending institutions are funded by contributions from member countries, meaning that when they lend money, they are essentially redistributing pooled global resources to support nations in need. This creates another layer in the global debt system, where countries may owe money not just to private investors or foreign governments, but to cooperative international organizations designed to maintain economic balance and promote development across the world. Government debt is not simply a sign of economic weakness, it is a fundamental part of how modern economies function. Most advanced and developing nations rely on borrowing as a strategic financial tool to manage public spending, stimulate growth, and respond to emergencies. Rather than waiting to collect enough tax revenue before funding essential projects, governments issue bonds to raise capital immediately. This allows them to invest in infrastructure, healthcare systems, education, defense, technology, and public services that support long-term national development. Large-scale infrastructure projects such as highways, airports, bridges, and energy systems require enormous upfront investment. Few governments have enough surplus revenue to pay for these entirely out of pocket. By borrowing, they can spread the cost over many years, allowing future generations, who will also benefit from these projects, to share in the repayment. This approach mirrors how businesses finance expansion or how individuals take out mortgages to purchase homes. Debt, in this sense, becomes a tool for growth rather than a burden created by financial irresponsibility. Government borrowing also plays a key role during economic downturns. In times of recession, natural disasters, or global crises, tax revenues often decline while public needs increase. Governments may borrow money to fund stimulus programs, unemployment benefits, healthcare support, or economic relief packages. This injection of spending can stabilize the economy, protect jobs, and prevent deeper financial collapse. Without access to debt markets, governments would be forced to drastically cut services during crises, potentially worsening economic hardship. Financial markets depend heavily on government bonds as stable and predictable investment assets. These bonds are often considered low risk compared to corporate investments, making them attractive to pension funds, banks, and insurance companies. Because of their reliability, government bonds help set benchmark interest rates across the economy. Mortgage rates, business loans, and other forms of credit are influenced by government bond yields. This means public debt plays a structural role in shaping the broader financial system. Additionally, borrowing allows governments to manage cash flow more efficiently. Tax revenue is not always collected evenly throughout the year, yet public expenses must be paid consistently. Short-term borrowing helps smooth out these timing differences, ensuring that government operations continue without disruption. Through this mechanism, debt supports stability in public administration and economic management. In modern economies, debt markets are deeply integrated into global finance. Investors, institutions, and governments participate in buying and selling sovereign bonds every day. This ongoing activity supports liquidity, investment strategies, and financial planning worldwide. Government debt, therefore, is not an isolated issue, but a central component of the interconnected economic system that drives trade, investment, and growth across nations. In the end, the question is not simply who countries owe, but how they manage what they owe. National debt exists within a vast network of investors, institutions, governments, and citizens who are all connected through the global financial system. Borrowing is not automatically a crisis, it is a tool, one that can either strengthen a nation's future or create serious challenges if handled poorly. What truly matters is responsibility, sustainability, and economic growth. When governments borrow wisely, invest productively, and maintain the confidence of their people and global markets, debt becomes a foundation for development rather than a threat to stability. Understanding this perspective allows us to see national debt not as a mystery or a looming disaster, but as a central feature of how modern economies function and evolve.